For today's video, I've prepared a presentation about Alibaba. You've probably heard about Alibaba.com and AliExpress, and that is because these are the global retail and wholesale websites that they have. So the difference between retail and wholesale commerce is retail is direct to consumer, and then wholesale is where products are being sold in bulk to businesses. So that is where you can get your own logo on things and find suppliers for your product or your business. The service that Alibaba delivers is actually not in selling the product. They have a platform where they have traffic. They have traffic from retail customers on their retail platforms, and then they have their wholesale where business owners go on and find suppliers for their product who can supply their product. So in China they have 1688 and one other site, and then they have for the global markets they use Alibaba. So we're going to go into how they monetize this in a bit, but just look at all of the different businesses that they have. They have Taobao, which is like the AliExpress shopping site for China, and then they have Fresh Hippo, which is like the physical supermarkets that they have, which is low margin, so that's not a really good business to be in. Alibaba Health, which is their like where you can get a doctor online and buy meds and stuff like that. But they also have some other here the social media. They have Youku, which is like their YouTube, and they are very good. It's like an ecosystem that they have built, right, where you go on Youku and you watch some of your favorite Chinese influencers, and then they maybe make reviews on some kind of product, and then they send you directly, and those two sites integrate with each other. So you can also go on Taobao and scroll the products and then click on the little icon, and then you can get onto probably one of the social media where the content sites, and then you can watch some content about that product. So they all flow nicely together, and that is this ecosystem that they've built, where they now have more than 1 billion active Chinese users in. So yeah, mostly of the revenue comes from the China segment. You can see 66% of the revenue comes from China commerce retail, and all in all, the commerce segment makes up 87% of the revenue of the business. They also have cloud computing, which is growing every single year. You can see percentage of revenue in 2019 that was 7%, and then has been 8% the 2 last years. So that is a growing segment, and that is probably going to be like 10% in a couple of years, and then we are going to see the benefits of the higher margins from that business starting to affect the rest of the company. So then they're not really making too much money off of the digital media and entertainment, but they of course use the digital media companies to sell products on their retail sites. So that is kind of how they do that. So monetization, this is taken from page 89 in the 2021 annual report. So if you want to dive more into how they monetize their business, but essentially I've taken the biggest segments here, which is China retail commerce, makes up a lot of the revenue, 66%, and then that is split up into customer management and then others. And customer management, we're going to go into that, but let's read this first. So they make revenue from merchants by leveraging customer insights and data technologies, which enable brands and merchants to attract, engage, and retain customers, complete transactions, improve their branding, enhance operating efficiency, and offer various other services. So I imagine they have their like Alibaba Pay, which is like a safe way for consumers to pay. They probably make some money off of that. They also, if you're like on Alibaba, you have to pay a fee every single year, like 10 grand or something, to be on their site, and then you can buy like a gold rank and get more exposure and stuff like that. So it is also like an advertising platform where they use their own platform, and then it's kind of like Google actually. You get higher ranked in search if you pay Alibaba some money, and then they have these insights on their consumers' habits and what they like to do, so they can sell that to merchants. Customer management, that is basically where that that could be a couple different things, but mostly it's merchants, they bid for keywords to rank for, just like in Google when you want to use Google for advertising, and then also commission on value generated. That is also something that they do, where they take a cut, like they take 5 or 10%, or I don't know how much actually, of the transaction. So those are a couple of ways that they make money, Alibaba. Now we're going to talk about investing for the future, because this is very important when we look at a business, right? And we have a fast growing business like Alibaba. The reason that they are fast growing is because they invested back in, now we haven't got years, but this is like the last year and then year before, and you can see they have invested big amounts in comparison to what they were making at the time every single year, so they would be able to grow very, very fast. And that is the single most important reason for their growth. That is, they've spent money on growth. Right now they are heavily investing. You can see they spent $31 billion last year from their cash flow on investing activities, and so that's a good portion of their cash flow that they spend on that. And then you can see here their return on invested capital is really what I want to look at, because you can see it has been around these, the 5 year is 10, so it's been around 10% return on invested capital. That is the return that they generated on the money invested in the business through debt and equity. So essentially, when they take on debt, they can use that money for something, or when they use their cash flow to invest, they are going to generate some kind of return, hopefully, on that money, and that has been an average 10% over the past 10 years. And that is good. That is a good return. We want it to be greater than 9%, usually is what we aim for. When they are getting a 10% return on the money invested and they're investing this heavily, that means that, well, we are seeing a nice return, and in the future, if they keep having a high return on invested capital, then we are going to see returns. Some of you guys watching have probably watched other videos on Alibaba and hearing people talk about the value is great, but we have the VIE-structure, but we have this going on, this risk and this other risk and this third risk. And today I want to, in this slide right here, discuss all of these risks and personally why I think some of them are, I wouldn't deny that there are risks, right? That's why I have them here, but I will kind of debunk them, some of them, and tell you why they are not that risky as some people might think. And that is really the reason that I personally also have invested in Alibaba. It is much, much easier to find value. People are irrational when it comes to risk often the times. I saw like Phil Town, a famous investor here on YouTube, also 500,000 subs or so. He looked at Alibaba and looked at Charlie Munger and how he's talked about Alibaba, and then he, at the end of the day, he just said, I'm not going to be investing in it because it's not an American company. So if that is the reason you're not investing in it, I think the risk have really gotten to people's heads, and that is why they don't longer see rational the value that is there. And that is kind of the same thing that happens in a recession, where people just say, I don't want to buy a stock even if it's just $1 and the company is worth, like, that is kind of the mindset where it gets out of control there. So here are some risks for Alibaba. Firstly, there are interest rate risks. So if the Chinese interest rate in this case gets increases a lot, because they have a bunch of debt that they use for growth and reinvest and investing for the future, then that could be more expensive for them, and then they wouldn't make as much from that investment as otherwise. But I read in this latest annual report that only 17% of their debt is not fixed rate. So 17% of their debt can move up and down with interest rates, but it's not like all of that debt does that. So that definitely takes a lot of the risk out of there. Definitely a risk, but not the biggest one. Foreign exchange risk. So if that currency fluctuates a lot, now we have seen for example, the euro has went down a lot compared to the dollar, and then it becomes a lot more expensive to buy American securities from Europe, which is where I live. So that is one downside. If suddenly the yen or whatever tanks, then of course business is going to be because they do most of their business in China, that is going to be catastrophic for them. But I also think there's a lot of risk that most people don't see, which is just like having 100% of your assets in America. That is what a lot of people have, and they think that the dollar is so secure. Maybe it's a little bit more secure because it's the reserve currency, but I really think that that is not much better, having everything that you own in one currency. I would like to diversify, which is what I've done and what I recommend for you. So exchange risk, you have that every single time you invest internationally. So yeah, risks related to doing business in China. For example, they held back the IPO of this business right here, Ant Group, where Alibaba has like a 20% stake, I think, in the business. That is a pretty big company, and it wanted to IPO, but then the politicians came, the government came, and they said, no, we can't have this, and then they stopped the IPO. So that is also one thing that made investors worry about doing business in China. What if suddenly also fines, which is one thing, they had to pay like $2 billion in fines for some things related to doing business in China. Ongoing geopolitical conflicts, changes in international trade or investment. Inability to decarbonize. Alibaba is another one. We're going to talk about ESG in a moment, but yeah, it's a big company and it could be hard decarbonizing and reaching the goals that they've set for themselves. And then delisting, which I talked about, and the VIE structure. ADR and this VIE structure allows these shares, this is the name of Alibaba on the Hong Kong Stock Exchange, allows those Alibaba to be bought and sold on the New York Stock Exchange. And through these ADRs, and basically a US investor go to a broker, purchase ADRs on the US market, and then they can buy foreign companies. It's a way of buying foreign companies on your local exchange. Since I'm in Europe, in Denmark, I also buy the ADRs, and there's no real risk to this as a buyer of the ADR. You still have all of the rights. It's just like a contract. It's just another way to own a company, and you could just as well go ahead and buy Alibaba shares on the Hong Kong Stock Exchange. The real risk with this is that if there's a conflict between China and United States, and then they decide to delist each other's securities, then some hedge funds that are only allowed to invest in the United States will not be able to invest in Alibaba anymore, because they can't buy the Hong Kong shares. Of course, that is going to lose some, potential money flow into the business in form of investment. That is really the only risk that there is, because these hedge funds, they have rules in place which doesn't allow them to invest outside of the US. So that is of course some equity getting lost there. But otherwise, if you are an investor of Alibaba, you own ADR shares on the New York Stock Exchange, and then suddenly a delisting happens, what would happen? Well, then your shares would get transferred into Hong Kong shares, and then onto the Hong Kong Stock Exchange, and then you would own the same bit of the company right there on that other exchange, and then you could just sell your shares immediately if that was what you wanted to do, cash out, and then it would maybe take like 10 days or 2 weeks for your money to get back to your original location, so let's say America, right? So that is basically the price you're paying, the risk you're taking with investing through this VIE structure. And to be quite honest with you, I know that there's risks, but I think people have massively overstated how big these risks are. And pretty much every video I watch here on YouTube is just like, the value is great, but I'm not going to buy it because it's outside of America, right? And if that is the mindset that people have, then they are not going to find these good deals, because you have to look where there's risk and where people are afraid to find these good deals. It's not just popping out of the blue. If they were delisted today, then I would still hold my shares, because I believe, there will probably be some short-term, very strong headwinds because of the press. But at the end of the day, the value is still there, and I don't think that would probably be the worst case of all. And I don't even think that worst case couldn't yield me a nice return. Maybe not as good as before, but still a nice return. So that is definitely the bear case. that we're looking at. So for the ESG, focused on here environment and social, you can see they have a couple goals written down here. They want to reach carbon neutrality by 2030. Then they want to slice their carbon intensity in half by 2030 also, and they want to have their cloud computing carbon neutral also by 2030. So they have very ambitious goals when it comes to protecting the environment and decarbonizing the company, which I think is great. And that is something that I definitely want for my portfolio, not to be just all oil businesses that are bad for the environment. I want to have some in here, not that this is like the best for the environment, but they're definitely trying to make an effort towards being more green. Social, their goal here is to increase stakeholders' impact. So they're going to do that on focusing on technology innovation, where they can actually make an impact on the world, and job creation, economic development. Those are just some things for ESG. I think it's good to look at, because that is something that companies that don't reach their goals and don't have any goals are going to be punished in the future. So share dilution is the silent killer of a lot of investors, and that is because a lot of investors don't look at this very important factor. So share dilution is basically when the company issues more shares. Basically there's a pizza which is the company, and then they make more, they slice it more times, which gives you a smaller percentage ownership and a smaller percentage of the dividends that you get paid out, which is essentially what it's all about, this investing game. So we want to see them buying back shares, which basically reduces the amount of shares outstanding and then gives you a bigger stake, which over the years will give you a bigger dividends. If we look at the past, 5 years here, you can see that they have actually diluted shareholders a bit by 5%. They have went from having 2.5 billion shares to 2.7 billion shares, and that is not very good. That is a 5% increase in shares, but they have just announced, here is an article, Chinese e-commerce giant increases share buyback program to 25 billion from 15 billion. So a sign of confidence for the company's continued growth in the future. And yeah, that is 25 billion is 8% of the Alibaba market cap, currently 320 billion. So essentially they're buying back, I don't know the timeline on that, there's probably the next couple of years that they're buying back 8% of the market cap. So now we're moving into another part of the analysis. Here we have the fundamentals analysis. When we look at the price to earnings ratio here, it's currently 34 times price to earnings, and the 5-year PE is 35. We have to keep in mind that this company has grown 30% revenue growth, 35 actually, for the past 5 years, every single year. Yeah, so we have to keep that in mind, that this is a growth giant that now has slowed down a little bit, down to growing 10% a year instead of 30. So that is why the 5-year PE has been so high. The 5-year price to free cash flow has been significantly lower at 21. Very important, and I think a lot of investors, when they just quickly look at Alibaba, they maybe miss out on this one, especially if they're not that good at analyzing companies, and that is the forward PE, right? You have to look at a little bit into the future. What are they going to do from their earnings? What are the projections by analysts on their earnings? Because that will impact the price to earnings ratio. So if you take the forward PE, you can see it's only 13. And that is because we have actually had a pretty much a fluke year this past year, with the earnings margins being incredibly low. So the decline in the core commerce business is due to ramping up of investments in several strategic initiatives, the growing competition from Pinduoduo, which is where a platform that helps farmers sell their and market their items, their products. Alibaba launched Tabao Deals, which does the same with lower margins, and they already have 240 million active users. So yeah, essentially they have launched some businesses which are lower margins, but what I could understand from this article is that it's expected to be transitory, this low margin thing, and it's going to return as the cloud computing segments grow, and as we return to normal circumstances, then the margins should go back from the 7% margins that they have now back to like 21 or what they had before. The price to earnings ratio of 13 is definitely incredibly low for still a fast growing company like Alibaba. So for the future growth, you can see, as we talked about growth, 17% forecasted annual earnings growth for the next 1 to 3 years. So here's a graph of that. This is where we are right now, and you can see it has dipped because of the lower margins. So the key takeaways is high growth right here, and Alibaba's growth is definitely not over, although it is slowing down, has slowed down from prior years. So financial position, they have long-term liabilities $20 billion. Their average 5-year free cash flow has been $20.5 billion. So that means that 1 year of their average free cash flow, the past years they've done a lot more cash flow, as you can see. With 1 year of their free cash flow, average free cash flow, not because it's been a great year, could pay off their entire long-term liabilities. Now we come to the intrinsic value calculation. What should we actually be paying for Alibaba? Normal case allows 10% return. We want to be conservative and still be able to outperform the S&P and the market. So I've taken here the EPS of the earnings per share, and you can see, as I talked about before, the fluke year is because this past year the EPS is incredibly low, 3.5, right? If we look at the 2021, that has been almost $8 per share in EPS, and this year is going to be 7.5, and next year it's going to be 9, according to 30 analysts. That is the average estimate. So what I want to do is, let's do 11 years of analysis or 10 years of analysis out in the future, but let's minus 1 year of growth from that, because we are taking, actually, we don't want to use this fluke year as our EPS, because then we would get horrible results. So let's just count from next year, because that is actually when, and then go a little bit conservative. Let's say they do $7 per share in earnings. So that is our number for the earnings that they're going to make next year, and then let's grow that out. Just imagine that this is 2023. The next 5 years, what can we expect of their earnings EPS growth? 9%. And then the next 5 to from the 5th year to the 10th year, what are they going to do then? They're probably going to do, like, let's say they drop down to 5. Even though they can't, let's say they don't grow 5% a year, they can still achieve that earnings per share growth from buying back shares, so that less shares, the earnings is divided by less shares, making the earnings per share go up. And essentially we have a discount rate, which is the desired return that we want. So the S&P generate a 9% return, but let's say 10%, because that is what I wrote. I wrote that we could get normal case 10% returns. So yeah, basically with this, the intrinsic value is $160. Right now the share price is $122, and you will get better performance than the S&P. Let's say I usually go for 12% return to really get that margin of safety in there, and still we have $38 per share as the price target. But here's the thing, I think they're going to be able to grow more than this. I think for the next 5 years they can grow 10% a year from buybacks and the growth projected by analysts, and that is still conservative if you take into account the analysts here on Simply Wall Street projecting for the next 3 years 17%. So I would still say this is actually pretty, this is not like a bull case scenario in any way, but 10%, and then they can definitely do like 8% there. And then my value is, and this is for 12% return, $150. And with that growth right there, we can probably expect a 20 multiple, the PE ratio, in other words. So my price target, I could probably go a little bit more bullish, but my price target is around $200, maybe 180, 100, but anything around below 150, I'm going to be buying. That was it for this video. I hope you enjoyed it. Have a great rest of your day. Peace out.